Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Hey, good morning, everybody. I am super late, but here we got this news coming out here in 15 seconds. I'm making the decision I'm not going to trade this, so we're just going to watch. But the best case scenario for the S&P 500 would be a number slightly underneath of the consensus, although I do believe that it's going to be above consensus. So here we're about to get the number here. And wow, 230. Wow, Goldman was almost right on. They were expecting 250. That is going to be a puke across the board. Wowzer. Wow. Oh my gosh. Yeah, you know what? Even if I wanted to trade this, I don't know if I can touch this thing now. This is going to be a mess today. Holy crap. Look at this go. Oh, I got to get the music going. Man, oh, that was like the best. I've been trying to paint a picture for you guys all week. Do you see the picture that I'm painting here? We're having a regional banking crisis. The things that the government has done in response to this banking crisis have essentially undermined the entire regional banking sector. And meanwhile, the economy refuses to slow down and continues to show signs of entrenched inflation. So that means that the Federal Reserve is going to have to continue keeping rates high. And that's going to continue to put pressure and cause even more regional bank failures. This is the scenario that I'm concerned about. And that print there for the non-farms makes it so much more likely now. That's you're going to see the stock market really puked on that one. Okay, so you say it's only been 12 points. Okay, so the move in the E-mini is, I would say, about standard for non-farms. That's true. That is not the case in the treasuries, though. That was a big move for the treasuries. Granted, they retraced a lot of it. That was a large move for the treasuries. And I'm concerned, you know, sometimes you'll have like the move in the treasury and then it just like it quiets down and stuff. I don't think it's going to be like that this time. I think these treasuries are likely to come back and visit these lows again, and the S&P 500 is probably going to continue selling. Is that below? Well, maybe. I would say for the like just the impulsive move, it's maybe average, but opinions on deep learning applied to, yeah, you can absolutely apply deep learning to the order book. Just realize though that the edges that you can gain just from the order book tend to be very, very short time frames. So you need latency to really make money with that stuff. Like you're gonna write an algorithm stuff, you want to be exchange co-located and all that stuff. Really this so let me come back here and show you. Okay, so Goldman's forecast was for 260, I think, and we got what, 230, 253. So Goldman was notably above consensus, expecting the number to be 250. They were almost spot on. Wow. Anyways, so their estimate on what the markets would do. If it was over 275, they said S&P sell off 100 to 200 basis points. 180 to 275, which is what we got, the S&P sells 0 to 100 basis points. Then if it was 125 to 180, which is slightly below consensus, they said 0 to 150 rally. And then below that, it was a sell-off of 50 to 150 basis points again. So like a number that was too high or too low would have been really bad. Anyways, I feel that like for the trajectory of the economy this year, that's like the worst number that we got. The issue is that as things have been kind of structured so far, the market hasn't really been feeling the rate increases, and I think that they're going to start feeling it. Now, part of this, if I come back over to like volume profile, yeah, silver's getting creamed. Oh wow, yeah, that, look at that. I mean, we had a volatile last 3 days or so, right? And that news just slammed us all down to May 2nd's numbers. So I can definitely recall some non-farms that like the initial move were probably bigger. You say that January was, let's see. Oh, this chart doesn't go back that far. Only goes back to February 7th. A funny thing too is that the S&P 500 is still up for the session, right? And it looks like they're continuing higher. That could present an opportunity actually. So like, no, it's okay. I believe you. You're right. I mean, even if we ignore that for a second, right? The S&P 500 has come right back to break even and is now trying to pull out a bull run again. You save us 55 points in January. This move in the treasuries was pretty big. But the pullback was pretty big too, right? So here's a scenario I could see playing out. The S&P 500 is trying to pull out a rally. The treasuries continue to sell on expectations, because remember, some people so this argument that we were having with Akshay on Wednesday, ends up being like a critical point for the market, right? So I still, based on all the information that I've seen at that point, the market was not pricing in a rate cut in July, but there was a point yesterday where it was. I would say it's still close to 50% though, right? Well, now that you got a really hot jobs report, we once again come back to no, probably not. The Federal Reserve probably won't be able to reduce rates in July. That's what I think this is saying, right? So if the treasuries continue selling off and break new lows, then you could, and it keeps going, at some point it's going to drag the E-mini with it, right? Also seeing a pretty strong rally in the dollar here. Wow, what we got puts the Federal Reserve in the most difficult situation, and it makes the trading the hardest for us, right? Like, this is going to be crazy the whole rest of this session. I think so. Well, okay, so when the dollar goes up, doesn't that mean a risk-off environment in equities should go down? How often does that correlation appear, do you think? Okay, so you are correctly identifying what a risk-off correlation tends to be. So either that's not what we're getting, and the buying in the dollar is based off of some other kind of a setup, flow setup, okay, which is not risk-off, or the E-mini is just going to get dragged down later. I don't know. The way that that's looking right there, that I think the E-mini genuinely believes there's a reason to continue buying anyways. Oh, now that's interesting. That's a good observation that I missed, Uzi. Oh, you know what? I think that my financial juice is not. Yeah, let's refresh it. Uzi says that March payrolls was revised down. Good grief. I really just to see a revision of almost 100K is like, really does make you say like the payroll numbers are bull crap. Well, so what it means is that the payroll number that we got is probably not as good as it appears on the surface, because number one, they revised how many jobs we created last month down, and it also kind of suggests that this number is also being goal seeked, and that this number is not as high. When I come back down in here, sorry, this month, Goldman is a notable outlier to the upside, the bank writing that it believes the payrolls number will be 250K, well above consensus, as high but falling labor demand more than offset continued layoffs in the information and financial sectors, and a roughly 25K hiring drag from reduced credit availability. Big data employment indicators were strong on net, arguing against a large credit lag. The April seasonal factors for non-farm payrolls have also evolved favorably relative to the pre-pandemic period and represent a tailwind north of 50 to 100K in our view. Doesn't dollar CLT treasuries equity relationships vary and depend on whether? Yeah, absolutely. And that's what we kind of need to sort out, right? Is okay. So the dollar's up. Normally, when the dollar is up, it pushes down equities. That's not what's going on. So something doesn't fit. I don't 100% understand what the flows are, but we have a very interesting situation that we should continue to monitor here until we understand what's going on. Layoffs mathematically make more sense. Well, layoffs would be like a more leading indicator, but I think that the issue that you have, I mean, we know what the layoffs already are, right? The issue is that people are getting rehired back into the economy really quickly. So I say the reality is that we just don't have a good window into what's going on in the economy because I just don't trust the non-farm number anymore. I don't think that number, you know, again, Goldman predicted that the number was going to be 250. Okay. So they got it right. It's the revisions that I'm like, that's total BS. You know, and it's not even necessarily that I can prove that there's like something wrong with the number. You know, that like, sorry, let me come back over this main screen. I mean, the implication is that the BLS is like fudging the numbers to favor the Biden administration. I'm actually becoming less convinced by that theory, because if you were the Biden administration, and you actually understood what was going on, that number is like the worst number that you could put out right now, right? But instead, what I think is that their methodology is extremely in this situation where we have this huge outlier event in the pandemic that is screwing up all of their monthly revised numbers and stuff like that. It makes the jobs report less effective of a window into the economy, is what I think is going on. Well, they changed the methodology in January too, though. But let's shelve that one for now. I'm more interested in how does the S&P 500 pull a rally out here? My understanding is that they change the methodology every year, Uzi. Or rather, okay, so something that you really got to keep an eye on is that the February numbers are usually significantly different, because that's when like new weightings and methodology changes go in. So even if like the overall methodology doesn't change, like the weightings that they use change every year. No, it's because there is an inherent flaw in using seasonally adjusted numbers, because you have to adjust the numbers based on the past seasonal history, and that might lead to certain statistical aberrations or disadvantages based on what the seasonality was last year or whatever. So they kind of and also, you know, there's things where like I want to weight it seasonally, you know, when do I incorporate that data in? And they choose to do it in February. So I don't think that there's anything fishy about that. I mean, I wish that it was I think you're saying it is in, well, the problem is what I'm saying is, yeah, they do change the methodology every year, or at least they change certain weightings every year, right? And there's reasons why they do that. But that doesn't prove politically motivated adjustments, right? I mean, but again, I think you guys are missing my point here, right? If this was an attempt to manipulate the market with the non-farms payroll number, that was like the worst number you could possibly put out, right? Proves the numbers. Well, yeah, I mean, if you look at like non-seasonally adjusted numbers, it's gonna be you know, you get some interesting stuff. Yeah, did you send this to my Proton mail? It's usually easier to send stuff to me on Discord, but So in this chart that you sent me, Tickard, why are there two inflationary columns? It says inflationary, deflationary, and then it shows the asset class relationships. Anyways, I mean, back to the question. Trading Bunny is correct in that the number that I saw there, at least the headline number that we get, suggests inflation, but there was a downward revision from last month. But if we were to just look at the 250K, that's screaming inflation is still a problem to me. What I would expect to see is treasuries sell, equities sell, and the dollar move up. It is showing if the dollar goes up or down when inflationary. Yeah, but why are there two inflationary columns? The question is, why is there two inflationary columns? I mean, the reality of it is that the correlations between assets are constantly in flux. And the whole thing is to try and analyze what those flows might mean. It seems to me that over the past week or two, that the S&P 500 has just been in buy mode no matter what, you know? So I kind of almost feel like I can just ignore this one. Like everything else moved the way that it was supposed to. And I mean, even the E-mini moved the way that it was supposed to. It was just like, oh, okay, we did the thing. Now we can go and trade what we actually want to trade today, which apparently is up. Oh, so you're saying that there are inflationary regimes where the dollar goes up and inflationary regimes where the dollar goes down. So if the dollar goes up, we should expect commodities to decline, bonds to move up, and equities to move up? No, that's not what happens. What happened was the dollar went up and bonds went down. Which is what this chart says will happen in, oh, actually, it doesn't have that scenario in there. Yeah. But, I mean, this has been kind of the issue, is that you're seeing inflation across the world. So, normally when you see inflation, that's generally bad for the dollar. But because everybody else was having inflation too, and some even worse, right? It ended up that during that inflationary regime that we had, the dollar moved up, right? The dollar moved up and bonds moved down. That was the correlation that we saw over the last year. So it's a good attempt with a chart, but I'm just saying, like, it's such a complicated thing. You can't just say, oh, this, you know, here's the situation, here's the way that they should go. It's not that simple, unfortunately, right? And so instead, what we need to do is we need to look at the correlations and then come up with 4 theories about what is driving those flows, right? So my theory is, in jobs number high, that means inflation is still a concern. Federal Reserve needs to raise rates. That should mean treasuries up, dollar up, because more money will come into the dollar seeking the higher yield. So you get dollar up and treasuries down. Sorry, did I say treasuries up? Should see dollar up, treasuries down. That's what we saw. But that is also tends to be a negative for the S&P 500. Higher interest rates is bad for the equity indexes. And so far, the equity indexes is fighting it. So my theory would be, or the trade that I would make if I was going to take a trade today, I decided that I'm not, because I started late and I'm not feeling myself, I'm not going to take a trade. But if I was going to take a trade, I think that it would be selling the S&P 500 here. Oh, okay. Okay, so is the order flow data accurate? So what do you mean by that? Okay, so I'm gonna try and explain something really, because it sounds to me like you're asking a question that's like actually ends up being really complicated. It kind of feels like a gotcha check question, because you might not like what I say, and because it's really nuanced. Well, I'm just going to assume that I understand your question, and I'm just and then you can clarify, okay? So of course, the data that I get. Well, okay. So now you're asking a different question. Let's address this one first. Why do people use futures data when the Forex market is more volume than the futures market? Because the Forex market that you see is not actually like the actual market. So like when you're trading Forex, what you're doing is you're trading with your broker, and then your broker goes out and trades with the banks, right? Because the Forex market is basically big banks trading with each other, right? So you cannot see volume in the Forex market because of that, right? Like you can after the fact, and there are some ways where they kind of like get together like volume stuff, but you cannot see order flow in the Forex market. The way that the Forex market works makes me not want to trade it. Okay. And there's reasons why basically like all of the Forex brokers in the United States got kicked out. Okay. Now, the data that I get from my broker, Rhythmic, is accurate. It's 100% accurate. Okay. That is to say, the information that it gets there is 100% true, right? But the kind of like categorizations and so forth that we try to make from that data is a really close estimate. It's not 100%. So when it's especially when we're coming in and we're saying 274 of those orders were buys and 4 of those orders were sell, or whatever the deal is, right? That may not be 100% accurate. My numbers say that in the worst case scenario, it can be off by 20%, which doesn't make a difference to anything that we do, but it's just kind of an interesting quirk about how we utilize order flow data. If you have market by order data, then that information is 100% correct. Yeah. Is the spot price of the dollar index kind of negotiated with the currency swaps in the over-the-counter market? Oh man, I couldn't even begin to fathom what the correlations are there between that. So the dollar index is a calculation created by looking at a bunch of different currency pairs. Okay. But there is a place on the ICE exchange where people trade the dollar index. So can there be, can I go into the dollar index on the ICE exchange and buy a ton of it and it move the other currency markets? Probably. But who's to say how strong those correlations are to each other? But what I would say, the thing that would matter to you as a retail trader, if you are looking at a currency, is to realize that what you are looking at in the Forex market is basically large trades occurring between banks. Okay, like Wells Fargo says, oh, we're going to have to do more business over in Europe, so we need to move some of our dollars over into euros. That's what is the primary driver of that market. Okay. And when you trade Forex, you're just trading with your broker, and then your broker is able to rebalance things with the broker, or sorry, with these banks, right? So there's not like it's centralized exchange and all of this sort of stuff for the Forex stuff. It's a different thing, kind of like over the counter. The structure of the Forex market is completely different. And the way that you interface with the Forex market is completely different. And as a result, the data that you get out is different as well. Basically, you can only see price data for Forex, which is a huge disadvantage in my opinion. Mr. Bond says S&P is probably being carried by Apple earnings. Could be. Could be. I wonder, like, how much money has to come into the S&P because of Apple, though. The discrepancies between broker feeds and Forex can be staggering. Yeah. In a way, no. So, like, if we talk about oil, for instance, right? When I'm trading oil, I'm trading it in a centralized exchange where all of the bids and offers are there. Now, I'm trading the sweet light crude oil market. There's also the Brent crude market. right? Okay. But this comes back to another misconception about order flow, okay? Which is that the way that most people want to try and approach this thing is, okay, I have this data, and then I'm going to take this data and I'm going to use that data to make a prediction. Here's my prediction, right? Well, if the data that I'm looking at isn't all of the data, then how do I make a prediction that's actually accurate, right? And that's kind of the thinking behind this sort of a thing. So if you're trading in a market that is really fractured, where like, yes, you're trading it on a centralized exchange. So like gold would maybe be a good example. Okay, yeah, you're trading gold on the CME. That's a thing. But most of the volume for metals happens on the London Metal Exchange. That's probably changing because the London Metal Exchange is like did some shady shit and nobody trusts it anymore. But and I think a lot of that will move over to the CME. But that's like there are markets where this isn't the only place that you're trading it. Or when you're looking at stocks, there's like dark pools and things like that, right? Okay. Well, again, the mistake that you're making is that you can take all of this data and actually make a really effective prediction of what price is going to do over the next, 30 minutes, hour, or something like that. Okay. The reality is that you take all of this order flow data and you try and predict what it's going to happen in 30 minutes, using only that order flow data. Generally speaking, it's not going to be very effective. Okay. But what I can do is I can see what the current conditions are so that I can get good spots. I can see where like imbalances where there's meta orders coming in and out and so forth. And so if I understand what's going on in the market, I understand like why people are buying and selling and who the different forces are that are behaving in that market. I can basically map out what the imbalances are going to be ahead of time, right? And then when I'm looking at the order flow data, I can see how that order flow data fits with what my predictions are. So if I'm predicting that the non-farms payroll number was really good, ergo I should see buying in the S&P 500, well, the initial move was down, so that kind of would contradict what you're thinking, right? And so you would have to throw that thesis in the trash bin, right? That's really how you have to go about it. Okay. And the thing is that if you have like information going on in another market, okay, well, that information is generally going to be reflected in your market as well. But instead of seeing it as like, this guy buys and sells it over here, okay, because he's a large meta order or whatever the deal is that's going on, right? Over here in my market, what I'm going to see is the robots that are trading the arbitrage move it. So for instance, something that you could see happen in the treasuries is maybe on the cash exchange. So on BrokerTech, maybe on BrokerTech, somebody comes out and decides to sell a ton of treasuries and they're just hitting all of the bids and they're just plowing it through, right? But when I come over into here, if that's where the volume was happening, I might not necessarily see a ton of sell volume over here. I may just see the bids kind of pull out of the way and move down as the robots adjust their best bid and offer based on the cash market, for instance, right? So I can still see what's going, like that information is still reflected in my market in the order flow. It's just that, again, I kind of have to understand everything that's going on, right? Just seeing the orders themselves in my one market isn't enough information to actually understand what's going on and make really good trades, right? That's why I have to look at multiple different markets. I have to have expectations of what the flows are going to be. I have to understand who the different players are and what they might be doing right now based on news and everything else, right? So like Mr. Bond earlier saying, well, okay, the non-farms payroll that we got is bad, and the S&P 500 did sell off of that. But there's also Apple earnings were better than consensus expectations, right? So that's going to lead to some buying, and that kind of like passive buying that you tend to get in the S&P 500 is a really, really powerful flow as well, right? So we have to, you know, that's something else that we would have to factor in if we were going to make a trade in the S&P 500. Seems to me like this has really got really quiet. No? Why concern yourself when you have the fibs? I think Fibonacci is like one of the funniest things, because there is really like most of the technical analysis methods of analysis and so forth that you see out there, I can understand why people believe it, right? Like usually there's some sort of a kind of a statistical anomaly associated with that you will pick up on. But because we can't see all of the data, you know, markets are fat-tailed, etc., 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 you know, you can't see the full picture, right? So you will see like, oh, it sure seems like there's a tendency for X to happen. But it's just that like when you actually trade on that every time, you realize that there's actually no edge to it, right? That's the way that most of these things work. Like some of these price action setups, you know, like the market does have these tendencies to do these certain things. It's just that, and they will actually have periods where they do well because they're taking on a lot of risk and all of that. But if you actually backtest it over a 5-year period, you'll see that it doesn't work. And it's actually even more interesting than that. It appears that like retail traders, that strategy getting popular actually made the strategy perform better for a period, and then it got too popular and it started performing terribly. Okay. But Fibonacci numbers, that's one where there's just like, there is nothing to it. Like if you go in and you start just trading on fibs, like you're almost immediately going to be like, this is bullshit. Like it doesn't react to my price at all. Like why did anybody ever care about fib numbers? Well, so let me tell you something. My mentor, he also was like, man, Fibonacci numbers are like total bullshit, right? But he loved to use the NinjaTrader Fibonacci indicator, because he would come over and he would do something like this, where like we pull this out and zoom in on it a little bit, and then he says, okay, we had a Fibonacci retracement from here to here. What's the 50% level of that? Instead of using the fib numbers, he would use the 50% level of that. And then you come back and you look at it and you can see that we kind of, you know, well, we pierced it, but we seemingly reacted to that level twice, right? And so he always noticed this, that like, there seemed to be this thing where if there was a retracement, it was really common for the market to retrace 50%. And you say, well, okay, but can you actually prove that? Can you actually trade off of that, etc., etc., etc.? And this is where I think he was actually picking up on something real. But it's actually like way more complicated and sophisticated than that, right? And what is it that we're picking up on? We're picking up on the square root law and the 2/5 law for post-meta order impact. Okay, what does that mean? So if you have trade 1,000 lots, okay, I have this thing and I say, here is lots and here is the change in price. Okay, if I trade 1,000 lots, it moves the market this much. And then you think, if I trade 2,000 lots, I will move the market twice as much, right? That would be a linear relationship. And what we actually find is, like, at first it does appear like it's linear, but then as you go along, you find out it follows the square root law like this. Okay. So there's like an upper bound at which more orders doesn't affect the market, and the market just like absorbs them. And then there's a further point where if the, it's too much, then the market becomes unhinged, like it did yesterday. Okay, but we don't typically talk about that. Okay, so if you have a large meta order, somebody that's like has a large order and they're just persistently buying over a 30-minute period or whatever, right, splitting the big order up, the impact on the market is going to follow a square root law. Or maybe it's not one person executing, maybe it's a bunch of different people executing all off of the same premise. Okay, when that ends, when that flow ends, there tends to be a post meta order regime change. Okay, like this. And this one, so I'm actually going to try and draw this more accurate to scale. Okay, this one follows a 2/5 law. So while this one is like y omega times the square root of the size of the meta order over the volume, this one is y times omega times q over v to the 2/5. Okay, which if you take 2/5 and you divide it, into 1 and whatever, you get 2.5, right? So that would be like if you did 5 over 2, right? Then you'd say 2 goes into 5 2 times, and then you have 1/2, right? 2.5. Okay. Anyways, so did you just talk in Chinese? The gist of it is that the length of the meta order and the length of the post regime change, okay, this ends up being 2.5 times this. Okay, so you can take this, if this took 5 minutes, then this decay period will take 12 minutes. I'm teaching you something hyper advanced. But if you just remember 2.5, you get into that thing. Okay, and this post regime change bit that you get right here, that's what my mentor was seeing, that he says it tends to come back 50%. So you could actually try and calculate it. Like you could say, this is how far it moved, and so this is how far the decay should be, and calculate an estimate about exactly where it's going to go. But I find that that's not necessary, because you can just kind of see it happen, and then it gets stuck in an area and you're like, okay, this is the area where it's basically settled at, right? But that's what he was seeing, and it very often it ends up being somewhere around about 50%. That's what he was seeing. So you can use that. You can definitely use that to your advantage, right? Because now you can say, oh, okay, if there was a big move and I caught like the tail end of it, I really don't want to get in that, because what's going to happen? Post regime change is going to come in and I'm going to come back and I'm going to be stuck up here. And then I might get squeezed out of my trade. If there's going to be another leg, which is what I'm hoping for, I might get squeezed out. So I might as well wait for it to come and settle and find a range where it just like goes sideways for forever, right? Because that's what the tendency is going to be. So you can absolutely use that to kind of optimize your entries, right? You can also use that to come in and say, okay, well, I think there's a large meta order that's going to be like this, and we're only right here right now, so I should be able to buy it because there's probably plenty more of the meta order, and this is what my reward is going to be, right? You can do that too. So even though it doesn't give you as much of a okay, when this happens, then you go and you buy, right? But it does give you information that you can use to your advantage, right? Thank you. Well, I appreciate that it's helpful to you guys, because that's what I'm trying to do. Because I want you guys to be successful, and I want us to be able to work together to make better trades. And so if you guys found value out of that, then that's really good. That means that I'm doing my job. So Techard, you said something else. And you kind of hinted on something else that I find really, really interesting about the markets. So we're all in the auction, and the brain likes round numbers and percent discounts or profits. 100%. 100%. So one of the strongest, most established statistical aberrations in the order flow that would differ from like a random walk is that the market likes even numbers. There, on average, will tend to be more liquidity and more volume traded at 116 even, just because it's 116 even. And you can see right here in the market right now, yeah, there's 18, almost 1900 contracts there at 116 evens, and it's a little bit more than all of the other prices around it. Same thing on the other side, 16. 115, 16, 16 is a half of a handle, right? There's 2,200 contracts on there, which is quite a bit more than most of the other ones. The only other one that's like more was like the bottom end of that last swing at 20, where the liquidity got left behind. Okay. The most proven statistical aberration about order flow, and retail traders never think about that. Why is it that they're so concerned about Fibonacci numbers and they don't actually go back and look at the even numbers and say, oh, you know what? It seems like the market does do weird stuff about even numbers. Like, it'll come to an even number, it'll trade around there a lot, and then it will move away from it. Totally does that. And that one might be a hard one to kind of sort out how you decide what to do. But it actually can tell you some things, right? Like, the way that I would take it is like, if I think that we're moving up and we're by an even number, you know, I might use that even number as kind of like a little range. I often like to get in and out at the even number over here in the micros, because I'm more likely to get filled in those locations. But you'll also notice that when I really try and sweep it as we're like moving away, like I'm trying to, as she goes, catching the edge kind of a trade, I would prefer it to be off of that number when I think that we're about to leave that number. It's just little things, right? So everybody wants the market to just be like, okay, when this moving average crosses over this moving average in this situation, this is the trade that you take. And the reality is that what's really moving the market is this guy needs to buy, and this guy needs to sell, and this guy needs to buy, and this guy is buying a lot more than these guys that are selling. And so we tend to move up. And, you know, whether the pattern that you're seeing about the opening range and the previous day's point of control and all of those sorts of things has absolutely no impact on that this guy has to buy X thousand contracts today. That's why those sorts of things, metrics, aren't really very useful, right? But we can take all of the teeny tiny little things that we do know that we can prove and combine them together, and you can actually build a pretty reasonable edge off of them, especially when you start to factor in those informational inefficiencies, the things like that Apple earnings were really good, and that we're, you know, likely to see some buying from passive buyers and so forth that have systematic strategies, right? That's like a huge informational inefficiency that could help you determine what the market's going to do. Yeah, whenever somebody tells me that they trade with fibs, I'm immediately like, okay, This person has no clue. That to me is like the biggest warning sign that this person is new and doesn't really know what they're doing, is if they're really interested in Fibonacci numbers. Because almost all traders have heard of Fibonacci numbers, but like if you start trading it, you will almost immediately be like, this doesn't do squat. The other ones, like price action, it'll take you a year or two to figure out that it doesn't work. Okay, but Fibonacci numbers, you only have to trade it for a few days before you realize that, oh, this is kind of junk. Okay, so price action takes longer to figure out that it doesn't work because they are kind of related to certain statistical oddities in the markets, just they don't actually provide an edge for you. So you're gonna, and then on top of that, they use a lot of risk. So if you're using a lot of risk, it might be a year or two before you like run into the market where it just comes for it, right? So as an example, I think I'm going to make a video about this one because I think it's so effing interesting. I'm going to pull up the back test here. It takes a little bit. Oh, it's been a while since I pulled this up. I think it was this one. Hopefully it'll pop up correctly. Might have to just run it again. Oh, okay. Yeah, so here on this one, like, look at this. So just realize when you're looking at this chart that I have up here, this is 2016 over on the far right, and this is 2023 over here, okay? So, if you started trading price action in March of 2020, right, you're probably thinking you're doing great, right? Oh, a little bit pullback, but then it starts to work, and all the way up until about May of 2022, you're thinking this is awesome, right? And then what? Then you start getting screwed. They start getting screwed. You're sort of giving them some credit. Well, I would say that it's probably better than some other things that you might want to do in the markets, but ultimately it doesn't actually provide you an edge. It's an illusion, right? It's basically, it's a strategy that's like good enough to give you the illusion of an edge if you add a lot of risk to it. That's kind of, this is the real problem with these strategies. I know that we've talked about this before, and you know, you feel the same way about it, right? If you're going and you're trading a strategy where you have an equal risk reward, then you get really good feedback about what you're doing. But if you go in and your stop is like 4 times what your target is, you're going to win most of the time. And it's not going to tell you anything about how well you're actually trading. And that's what most of what is happening in price action is. It like is just enough to fool you, and it can fool you for a really, really long time. But ultimately, you're just it's just a risk premium strategy, which means it's only making money from taking on risk, and without any other kind of edge to it, eventually you can get screwed. this one in particular, I don't know if it's really giving price action traders so much credit as it is telling you, oh hey, like a mildly popular strategy can actually start to do well, and then when it gets too popular, it just gets creamed. Like I've been trying to tell people this from the very beginning, and the response that I always get is, well, but we're so small compared to the rest of the market that we really don't matter. I view this as proof positive that a bunch of retail traders all trading the same kind of strategy can move markets, and that it is to your detriment, that any strategy that gets popular, that the market will eventually come for it. That's what that says. What? Former CIA officer says decision to drone to track Kremlin was made by the... I don't believe that story. I think that's somebody that's talking out of his butt that shouldn't be. Decisions on such attacks are not made in Kiev, but in Washington. Okay, so yeah, that's exactly what it is. He's saying, first of all, he's assuming that everything that the Russians said about it is true, which I don't, you know, in a situation like that, we don't know what or who to believe, right? But he is saying that if a decision was made by Kiev to go and try and assassinate Vladimir Putin, they can't do that. That they have an agreement, and a decision like that would not be made without Washington's approval. But we have yet to have any information proving that it was the United States or Kiev. They were denying it. Interesting story, though. Okay, so wow, this is such an interesting. Okay, so now that we have a little bit more, let's return back to the conversation about, are the jobs numbers manipulated? Right. Ahead of today's jobs report, which we previewed earlier, and where median consensus expects a drop in payrolls to 185,000 with unemployment rising 3.6%. Many joked that at this point, the job report is so rigged and adjusted that Biden's Department of Labor may as well just keep going with fabricated numbers until the 2024 election. After all, one look at the chart below, which shows the number of consecutive beats heading into today's print, confirms what a farce the data has become. Everything in the name of a beat and a favorable press conference soundbite. And you can see here that we have had, like, what, 12 beats in a row now from the consensus expectations? It is definitely a statistical aberration. The problem with this is that this definitely shows us that there is a problem with our non-farms payroll. It does not prove that it is being goal-seeked by the Biden administration. His April payrolls reportedly rose by 253K, a big jump from the March number, and what is a 3 sigma beat of the expectation of 185K, which, by the way, we're always having like big sigma beats these days. And speaking of previous prints, the March number was unexpectedly revised sharply lower from a consensus beating 236K to a huge miss at 165K, a number which surely would have impacted the Fed sinking and potentially put a premature end to the rate hikes. But wait, there's more, because February was also revised down lower by 78K from 326 to 248, which also would have missed the whisper estimate. With these revisions, employment in February and March combined is 149,000 lower than previously reported, and then there was a downward revision in January too. Combined, this is how the downward revision looked. Oi, 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 oi. And just like that, we get confirmation that every BLS number is only gamed to beat the current month consensus estimate so that the Biden administration can take props for handling the labor market better than expected. No. I sure hope not, because again, having a high number is like, in my opinion, having continued good employment numbers is like the worst thing you could have right now. So it's like the worst thing you could have right now. If that's really what's going on, if there is a scandal for the Biden administration to manipulate these numbers and make them look good, then this is going to come and bite them in the ass so hard, because this number is not good for the economy. Right? Like this is basically like leading us into stagflation, right? Good job numbers gives them warm and fuzzies. Yeah, but having a deep recession in the second half of 2023, beginning half of 2024 is not going to give them warm fuzzies. Because what this essentially does is force the Federal Reserve to keep interest rates higher and make us more likely to go into a recession and to make the depth of the recession worse. I think that would make the depth. I'm still like really uncertain on this whole, like, how do you decide that the recession is going to be really strong or not strong? I'm not sure about that one, but it seems to me that holding the interest rates higher than you were supposed to would maybe make things worse, right? Oh, it totally would matter. Like, think of it this way, Uzi. Did the crisis in 2008 matter? Oh, yeah. Obama probably wouldn't have been elected if it was not for the 2008 crisis. So there's some interesting research out there about like what sort of things move people and cause them to vote. And things that are social issues and fear mongering tend to be very, very strong drivers. Okay, so like abortion, a very strong driver of how people vote, and one that has recently really turned against Republicans and has been a positive for Democrats, right? The fear mongering, so like after 9/11, all of the, you know, our global security and that sort of a thing, that's something that people tend to also like really moves their feet. And things like their pocketbook often take a back seat to those issues up to a point. But when it comes to the point where it is like materially affecting their quality of life, all of a sudden that issue jumps to the top of everybody's list, and like it sucks all of the air out of the room. Okay, so if we had a 2024 election within the context of a deep recession, like we're still in the deep recession and maybe just in the beginning stages of recovering, it absolutely would affect the election. So if the Biden administration is trying to manipulate these numbers, then it's not actually helping them in the long run. It's really not. But again, we don't have any evidence to suggest that the Biden administration is manipulating the numbers. All we have is evidence to suggest that there's something very, very wrong with how we're doing the non-farms payroll numbers that makes it not a very effective, at least that headline number, not a very effective gauge, and a really, really problematic thing if we're using that information to judge things like, should we raise interest rates, right? Now, I even Gen Z and millennials, if their pocketbook is really hurting, that'll trump those things. I would not count out on the abortion thing. Well, I'm not saying anybody's manipulating the number, right? I am saying that I don't think that number is a very effective reflection of what the job market is out there. I'm not saying it's because of the Biden administration or that the BLS is intentionally spiking it. I'm only saying that there are methodology problems with it, and that when we're in a time period where we had a really huge aberration in the jobs market 2 years ago, and so when you come into now and you start doing revisions and everything based on that information, the numbers that you get aren't very accurate, right? So it's really a case of like, I mean, the issue that you have with these sorts of things is that the economists that are all like putting these numbers together and everything, they probably know this, and they probably know that this is a problem, but like it's not such a simple thing to change that, right? And like in normal times, this methodology is best. It's just that right now, because of these excessive aberrations and month-to-month numbers, it's going to result in some problems. And it's, if anything, it's just kind of really problematic that they're now at least not saying something. Like if I was the BLS, I would be making statements to say, okay, well, like here's the number that we have, but just understand that this is our methodology and here's a problem with it, right? And so for the next, until that time period comes out of the seasonal revision window, you're gonna have to keep that in mind when you're analyzing the number. That's not accurate. The default position for Gen Z and millennials is a hurt pocketbook. So, it's kind of funny. Millennials have lived through the largest economic expansion in history, and most millennials came into the market during the recovery. So most millennials didn't actually experience like the collapse, or if they experienced the collapse, it was like the first thing that they experienced, right? So millennials have really not experienced this thing where you've been built up for years and years and years, and then all of a sudden it just gets wiped out in a quarter. But I think they're gonna. But I also, on the abortion issue, I continue to maintain that the abortion issue has kind of been morphed and distorted, and that there is still a possibility or an opportunity for the Republican nominee to shift the narrative on that. Because, well, see, when we ask about, like, do you believe in abortion or whatever, when you talk about, okay, most people, especially people on the left, when you say, do you support abortion, they're thinking about, oh, you did the P test and you just found out that you're pregnant, and so then you immediately go down to the clinic and you get the abortion. before the baby has like really even formed. That's what they're thinking about. Okay. And when Republicans are thinking about abortion, they're thinking about the baby has been in there, is 3 months away from being born, and then they abort it. That's what Republicans are thinking about, right? So if a Republican nominee is able to come in and say, well, I totally support abortion for like the first 8 to 12 weeks or something like that, but then after that, it should be illegal, right? And if that was their position, and that was like what was pushed in the debates and talked about and everything, and that was like the narrative, instead of this like we have to, the Republicans are trying to ban all abortion all the time sort of a thing, I think it would shift voters, because most people do not agree with late term abortion. Overwhelmingly, they disagree with late term abortion. So there's an opportunity for him to flip it. And more than that, I don't know if abortion is like the only issue, right? I mean, we know that it never quite comes down to that. For instance, in the last election, it seems that the abortion thing did energize Gen Z to come out and to vote for Biden. Okay, sure. But Gen Z doesn't like Biden, right? Even with the abortion issue, I'm not sure they're going to come out and vote for him. Right. So and the issue is like going back to the like if we have a recession sort of a thing, because again, we haven't seen a real recession since 2008. Think about how everybody reacted to the Silicon Bank thing, because that was, everybody was talking about, that was like a big deal, the Silicon Bank thing, and everybody was like way over freaking out about it, right? If we're having like a real crisis and we're like having a real recession, it's going to be all over social media, like people. And because the thing is, millennials get so triggered by this stuff, because like I said, they came in like right as it was happening. So it was like, it came in and it was like it traumatized them at like a key point when they didn't actually have anything to lose yet. Right. Now, I'm not saying that millennials have a whole lot of wealth, but I'm telling you what little wealth you do have, what little job you do have, and then that gets taken away. It's going to be rough for you. It's going to be rough for everybody. I don't know. At this point, there's been so many times where it seems like we're going to go into a recession and we don't. Because I always feel like, because of the nature of my job, that in that kind of an environment I might be vulnerable. But I don't know. I think that I don't think that I would have a hard time getting rehired, because there's just a lot of opportunities in the market for the kinds of things that I'm doing. But like the chances of like getting laid off and then moving somewhere else, I think, are really high in that situation. They'll vote for anyone who offers to give them free they're not going to vote for Biden, man. You're not going to vote for Biden in that situation. Well, no, and it's not programmers in general, but so the issue that you have, Lucas, is that a lot of information technology stuff is not seen as revenue generating key components of a business. So when you're coming in and doing cost cutting measures, a lot of what you do is, okay, all of these engineers that are working on your infrastructure to improve the infrastructure, we can get rid of them because, it works right now, and we can just move into, only emergency changes sort of a world is what you tend to get. So yeah, a lot of DevOps and infrastructure people often get laid off in those situations, which is often to the detriment of the company. They don't really know what they're doing, but that's the way the management tends to approach it, is they only view the technology sector as a cost. Yeah. So I may be vulnerable in a situation like that. So far, my company that I work for is so focused on the shift that they're making and moving everything over to the cloud and all that sort of stuff, that, you know, even while the rest of the tech industry has been struggling, they've just kind of held the course. But at some point that might shift. Although it's a healthcare company, which kind of tends to be a little bit resilient in a recession, so that's something that works in my favor. Well, now that we're seeing 4130, it's kind of turning into another one of those this is kind of zany sort of things. And it's probably a good time to remind subscribers about the Patreon link. I appreciate it, but if I were to get laid off, I think it would be very unlikely for the YouTube to completely replace that income anytime soon. It'd have to be a lot. Like what I've learned is that like a mildly successful YouTube channel probably wouldn't replace my income. So like if I had 100,000 subscribers, the advertising and donation revenue that I would get from it probably wouldn't be enough. It would be a big chunk of it, but probably wouldn't be enough. Actually, it would probably be enough to like get me going, but it probably wouldn't be enough to completely replace my income. Now, if you add on top of that, like affiliate links and the indicators and stuff like that, and I started doing a really good job promoting that sort of thing, then maybe it could. Why is sometimes the data at different providers different with each other? Well, because the order of there are two separate feeds. There's your level 2 feed that show you the limit orders, and there's your matches feed that shows you the volume. And those don't completely match up. And so the way that the sequence of events could be slightly different between different data providers, and that could make slight differences in the, you know, categorizations that the software makes about what is a buy and a sell. So again, not big enough to really make any significant difference to the way that we analyze. Like if you come in here and you see cumulative delta gently going up, you go over to the other chart, it's going to look exactly the same, as just the exact numbers on there are going to be slightly different, right? And the difference can be between 10 and 20%, which is not enough to change anything about how we use order flow. In music, an artist can make a good living with 50K. How? Like, what do you consider a good living? Sorry, I'm on the I have to replace like 100,000, more than $100,000 worth of income. Because not only would I have to replace the income, but I would also have to pay for the medical benefits on my own, which would be really rough for me. $200K off of 50K followers? No, how? They're making $4 per subscriber? That seems so crazy to me. That seems so crazy to me. Maybe it could work. I think when you add in like concerts and stuff like that, that might be able to do it. I tell you what, like the music industry is really effing hard right now. Like the, you know, streaming and so forth has kind of made it difficult to make money. And the labels like basically squeeze all of the money out. So the artists don't make very much. And most of what they make comes from touring now. Like my understanding of it has been, I could go and put a song out and become like the #1 song on Beatport and make like $5 from it. A million streams on Spotify is only 4K. Oh, okay. Well, okay. So that is one thing that is interesting to me is that like it's not that you can't make money from doing it. It's that the distribution of it is like insane. It has like insane amount of kurtosis, right? Like if I came out and I was really successful with it, you know, I would probably only make a few $1,000s off of it. Okay, but you know, for instance, Harris Heller, who makes the music that we're listening to right now, he gets so many streams on Spotify that he's literally making millions of dollars off of it, right? So like there's this scale, but it's like when I look at for my type of music and what I would make, what would be like reasonable, yeah, it wouldn't be worth it, right? Now, for our YouTube channel, it depends on how you take it, but if you just kept the channel to day trading, and I think the point of explaining this to you is when you think about other people that are on YouTube and why do they do these sorts of things and stuff like that. If you want the YouTube just to replace the revenue side of it, the YouTube advertising is probably not enough. That's what I'm saying. At least with current numbers. There was a point where it was, but not anymore. Right? So like I think of like Humble Trader is one that I look at a lot because everybody seems to like her. She's probably not making, you know, she's probably not making more than $100,000 a year just on the advertising, which is why she has like a little course that she sells, right? She add the course that you sell and like affiliate links and sponsored videos, and then you get there, right? Yeah. Now, I think that if my channel had 100,000 subscribers with the affiliate links and stuff that we have on there, I think it would get there. I don't think that I would have to do any kind of like high ticket, high pressure items in there and all of that sort of nonsense to get there, right? I think that I would be able to get there just promoting the products that I find useful and giving the things that I know will help you the most. So that would be the good thing about it. But I guess I've kind of moved away from, okay, the larger goal would be to be able to get all of your income off of YouTube so that you could spend more time making content for the channel, right? I've kind of moved away from that a little bit and moved more towards I'm just gonna put on the YouTube what I want and what I think is gonna be the most useful. Because like that goal is not that great. That goal of really making the YouTube channel successful wouldn't actually give me the freedom that I want. So I actually have the freedom that I want right now. So I should just make what I want. And what I want to do is I want to make a machine learning assisted large language model to talk to me during the stream. That's what I want. They move so fast. Well, Art, today is probably not the best day to start because you know you had a non-farms payroll, so you can get really wild and volatile order flow followed by like just a complete drop off in activity. So let's actually come back and look here. Oh, we have some Fed speakers later in the day. That's interesting. Well, anyways, I would say when you look at like so something that I notice a lot kind of subconsciously is like how often am I seeing changes over here? I'm constantly seeing changes on the inside, but like a lot of these numbers up here aren't changing. Numbers up here aren't changing, right? Like the amount of level 2 activity is really low. So this looks to me like they made their initial move, retraced it, and now they're kind of coming into like just leaving it dead now. Like the people that made money and went home. So, but next week you should get plenty of good order flow to watch. And I would encourage you to try and come stop in every day. You know, like when we started at 8:30 Eastern time. Because this is not something that can necessarily be taught. You have to train to do it, right? You have to come in and watch the order flow every day and train your brain how to see it, and train your brain how to analyze and interpret the informational content that's coming out in the market, like the news and stuff, right? It can't be learned. You have to train to do it. That makes sense. Is that when I say that, do you go, oh, that makes so much sense, Seth? Yes, yeah, you can't just learn it. You have to train it. You know, there are some things like history, right? I can tell you about the history and then you just remember it and now you know the history, right? Okay. But you can't just learn soccer, right? You have to train soccer. You have to go and actually like practice and play against other people and so forth to get better at it, right? That's what trading is like. You have to train. And so having somebody else here to kind of work together with you is like really, really beneficial, right? That's where I think the most value comes from the stream. And then even if you aren't able to come in here live, you can watch it. You can watch the replay later as well. So there's that too. Anyway, I was just thinking about something here. Okay, never mind. I was thinking about a setting. I was like, do I unlist them after the stream? No, I don't do that anymore. So all you have to do is go over to the stream tab. Well, I'm reading here through Twitter. Nick Timmeros, average hourly earnings rose 0.48% in April from March and 4.4% from a year ago. Hourly earnings are up an annualized 4.2% over the last 3 months. Average weekly earnings are up 3.8% over the last year and 1.8% over the last 3 months at an annual rate. Any games you could know? I don't know. Go play Stardew Valley. That's the... You know what I've been playing? This is dumb. Don't go play this, okay? They release Final Fantasy Pixel Remasters for the Switch. So I went and played Final Fantasy 1 Pixel Remaster. The gameplay of the original Final Fantasy is kind of mind-numbing. Like at the time, it was super, super cool. But now it's kind of like, ugh, this game is so repetitive and dumb, right? But the art and everything about like the way they build the levels and the way the game progresses is just so well done, so amazing. And they add in some effects and stuff for the Pixel remake. It's really good. I enjoyed just watching it to see the amazing pixel level animations and artwork. That's what I've been doing. And it's also really good because you know it's turn-based, so you can like set it down at any time really easily. Yeah. There's ever since the pandemic, so like here's the thing with the gaming world is that the industry was already kind of moving more towards this free-to-play season kind of model where like you have this one game and then twice a year or whatever you switch out the content, and you know, as players progress they unlock content, and then you change it again and there's a different set of content for them to unlock for the new season, right? So they're already moving to that kind of a model where essentially the gaming companies make less games and try and get more revenue out of one game and keep updating that one game. So the industry had already kind of moved to that, and then the pandemic came along, and the pandemic like really set back any kind of development anyways. And so the result is that if you want like a fun multiplayer game to play, there's just not new stuff. The next major game I know of coming out is going to be the one by Frost Giant, which is going to be a successor to StarCraft. That's like the next big one. Ooh, and actually that should be coming soon. It's May, and I think that they were saying May or June, so that might be coming. I don't know if that's something that you just play in between coding breaks. Strategy games kind of involved, right? I think overall, and this happens with cinema too, as technology improved, people got lazy and creatively declined. Maybe. I'd like to think that the people that are creatively inclined are like gonna be creative no matter what. So I'm trying to think of what else might be able to explain what you're saying. I think it's like the creative people aren't being given the opportunity to be creative. It's like the industry is less creatively inclined. You know what I mean? Because it's definitely the case with cinema that like they don't take chances anymore. Like everything is, we're gonna have our Marvel franchise and we're gonna squeeze that for all it's worth, and then they don't make any new properties. Say you were great, no, but can't do it. Can't do it. I joke you not, I used to love watching movies and TV shows. Wait, do you have a Crunchyroll subscription? Because I tell you what, I never run out of things to watch when on Crunchyroll. I think that anime, it's actually even broader than that. It's not just anime. It's I think that you just got to stop watching Western media. I think that Korean TV and Japanese anime, that they're still creative, they still care about storytelling, and they're making good works. You know, like the whole Squid Game thing, you know, that's probably the biggest, most influential artistic work of the last decade or whatever, you know. There's no mistake that it was a Korean show, and so many Korean shows are really high quality actually. I hate the emotionally heavy side of anime characters. It doesn't push the message. Yeah, but I don't think it's just about the message. So I think that that's a mistake that many of us on the right make, is that the reason that Hollywood is failing is because they're insisting on pushing the message. It's not that. What's happening is the message is making them ineffective at making movies. It's the opposite of what the conservatives think. So let me see if I can explain this by pointing out a piece of work that I think is really, really good. Okay. So there is a work that I would consider fully woke that was good. Avatar: The Last Airbender. Avatar, the people that made Avatar: The Last Airbender are like 100% woke, and they 100% tried to put that woke ideology into their work. Okay, and it was great. In fact, I think that Avatar: The Last Airbender was just the anime. The movie sucked. You're right. The movie sucked. There's going to be a Netflix series soon. I think it's supposed to come out this summer. Soon. Avatar is great. Okay. Even though it's woke. In fact, I think that Avatar was one of the first works to show Hollywood that, like, oh, actually you can like inject your ideology into things and do well. And that was when they started to push more of this stuff into their shows. It's totally woke. It's totally woke. So in the first series, okay, in the Avatar series, it's not, maybe not as overt, but it's definitely always there. Like the moral of the story to every episode and all of those sorts of things are all actually woke ideas. Okay, when you get into Korra, which was like the sequel that takes place in like a 1920s style world, then it really starts to become obvious until at the very end you basically have like the main character is a lesbian. Okay, so it's 100% woke, trust me. So why is it then that Avatar: The Last Airbender is so great and all of this other stuff that's other woke stuff is terrible? I'll tell you why. Because being woke makes you awful at telling stories, right? Because storytelling is essentially our society's, our species' greatest innovation in reality. The thing that truly sets humans apart from other animals, in my opinion, is storytelling. The ability to pass on experience across generations of people, right? And it's been going on for so long that they even think that there are certain like stories that are like basically ingrained into our genes at this point, right? And so then they come down to like there's like a certain number of like stories overall, and like everything is like a variation on those 6 different main story types or something like that, right? Okay. Well, when you're woke, being woke is all about bringing down existing power structures, right? Like at its heart, I mean, this isn't what I would consider the definition of woke, but when you look at what it's trying to accomplish, at its heart, being woke is about bringing down existing power structures, right? Which means that you can't tell a good story, right? Because all of your stories have to be about bringing down the past, essentially, right? And so when you come in and you want to start doing woke things, basically every creative decision that a woke person is going to make ends up being awful, surely by virtue of the ideology driving it. So it's not that the audiences don't like the woke ideas being injected into their shows and things like that. It's that woke creators just end up being bad at it because of what's driving their underlying thinking, right? So when you get somebody that was woke but was forced, wasn't actively trying to bring down the system and was forced to learn traditional storytelling, they can be really, really good and still inject all of their ideology into it and it be good. But then once they like totally embraced it, then everything that they put out ended up being terrible. Aang should have totally killed the fire dude. That's not woke, that's just comments. So funny, man. The entire power structure is centered around the message. You guys must watch the whatever drinker. Yeah, that's right, the critical drinker. Well, so this is what I find, this is what I hate about it so much, is that the idea is, on the left, is the past was racist and the past marginalized certain groups of people, and so we need to tear down the existing power structures and put these people that have been marginalized in the past into power, and they will be more just or something like that. Okay. But the actual policies, what they actually end up doing, always ends up being strengthen the power of the federal government and weaken local communities. When you really think about it, that's what all of these things do, is they increase the power of the federal government or global power structures, and they make your local community weaker, right? In my opinion, the most rebellious thing that you can do in this society today is to know your neighbors well and be friends with your neighbors. That's is that I'm trying to make that like this huge revelation sort of a thing, but I don't know if it's hidden. The most rebellious thing that you can do in this world, in America today, is to be close friends with your neighbors. Because every policy that I see coming through, everything that I see coming through on the media and through the internet and social media and everything is designed to increase the power of the federal government, increase people's ideological and how much they associate with the federal government, and reduce how much they rely upon and use their community, right? Like if you have a neighborhood and you know each other, you know, and you have something that needs to get done, and it's a problem, they come and they help. In Utah, we still have that because everybody's Mormon, and you know, everybody knows everybody in the ward. If you're not Mormon, then you would certainly feel like an outsider. Okay, but even if we knew, even if the ward knew and they knew that you weren't a member, they would still come and help you. Okay, and there's a real power in that in a community. When you get people that because you know, everybody's working towards self-actualization, and when you get a community of people that have self-actualized, right, and they have now moved on to trying to achieve the community's self-actualization. Okay, so you get this pyramid, right? And they say like at the bottom of the pyramid is like your basic needs, like food and shelter, and there's all these different levels, right? And for you, and then at the top of that is for you to achieve self-actualization. Well, communities and countries and so forth go through the same process. And when you have a community that is essentially at the stage of self-actualization, like that's an amazing thing. And that provides so much benefit, because you could have the community could be self-actualized, but you're not, and then the community can help you become self-actualized, and it's an amazing thing. And those communities are going to be self-reliant. They don't need the government's help, right? They need the government to go away and let them do their thing, because small communities, okay, that's what we were designed to be. That's what all of our evolution and, you know, millions of years of evolution in society and everything has designed, and the one unit of society, the family, and then your village, okay, is the structure that works really, really well, right? So well that it's kind of a threat to those of people that are truly in power, and that's why they're everything that they do is to undermine your small communities. And that's why I think that the most rebellious thing that you can do is to be good friends with your neighbor. Yeah, you can only maintain Dunbar's number. You can only maintain relationships with like 150 to 200 people. Yep, that's great. So you want to get that group of people that is like your subdivision, and you should know those people. That's the most rebellious thing that you can do. It's hard. I have a hard time doing it. I don't know everybody. I don't know everybody. That should probably be on my I have like a list of things to memorize, and I had like a bunch of things, and I'm like, oh, what are some other things that I should be memorizing? That's one of them. What are we rallying for? I'm still stuck on it must be Apple. It must be about Apple. Apple earnings were good, then you have to buy it. That's the only thing that makes sense to me. You know what? I think that there could be some of, you know, oh, the economic numbers being good actually is good. That could also be something that's going on. I can barely keep one friend. When you say that, just remember that most people only have one close friend. You think that most people have lots of friends, but that's just because you have one friend, and that one friend probably has like tons of friends, right? So you have like these social roamers that are like responsible for most connections, but most people only have one or two solid connections. And like I said, the way the society is structured is to discourage you from having close friends. You have 4 friends, real life ones, right? You don't, because I tell you what, if it came down to online relationships, then I have way too many good friends. Because there's not just those of you that are here, and I mean literally is like you guys are here every day. So really the kind of relationship that we have really is like close friends. Yeah. But a lot of people talk to me on Discord, and you know, like we're constantly doing stuff. So high school friends, that's good. Yes. But I don't really have well, I've been doing a lot of stuff with my uncle building this table. I'm gonna have to, you know, this is a problem with ADHD, is we're very bad at maintaining relationships. So when we're done building this table, I'm gonna have to work hard to make sure we keep doing stuff. He has, I tell you what, most of the projects around my house are like done. So now that I got the gravel out in the back, I do want to make a rock path on the side of the house. And I want to cut a door going into the backyard. But after that, that is like all of the long-term plans that we had. And I guess I can start doing other crazy stuff. Like I've been thinking, what if we made like a sauna or a hot tub and that sort of, you know, those were like the pie in the sky kind of ideas. Maybe we'll get into those, but I'm done with all of those. But my uncle, he's got a lot of big projects that he should really do in his house, and I want to help him, because to me it's like, dude, we can do these things, and yeah, he has the money. I mean, he lives alone, and he makes bank, so he has plenty of cash to do whatever it is that he wants to do. We spruce up your house and everything, and you sell it, you can make so much bank on this thing that you could just retire off of that alone. And then all of a sudden, I've helped one person achieve financial independence. If I have the opportunity to do that, I think I should do it. Yeah. Yeah, it's really hard for me to consider someone a friend just because we talk often and have a good relationship. Well, Yeah, I think most people consider those acquaintances, huh? But I really think that we should shift that. Like the way that I think we should think of it as like you have your inner circle and then you have your community. Right? The problem is that most people, they kept their inner circle, but they lost their community. Oh, you know what? I need to back out here on the dollar. What is the dollar doing? Okay, it's retracing the move. It's not completely back, but that's still quite a big move back down. So when we came into this, I said, well, I think that a higher than expected number would be really bad for the markets and is about the worst number that you could get. But I think that revision to last month's number really shifted that, right? The headline number, I don't think was very accurate of what information we actually got from this report. So that maybe that put the markets back into the Goldilocks zone. Although it really doesn't, because you know that next month is going to be revised, right? Whoever thought they'd be cutting rates in July is retarded, with all due respect. Yeah, you can really only have like 3 to 5 truly close friends. That's true. But the thing is that truly close friends, I think that a truly close friend has more to do with your willingness to rely upon them for emotional needs, right? That to me is kind of like what would differentiate the inner circle, because I think in an ideal world, you can rely upon your community for a whole host of other needs. Friends are overrated. Yeah, if you need a friend, get a dog. No, I'd subscribe to that kind of philosophy. I mean, being a trader is kind of a lonely thing, for sure, because the people in your community aren't going to understand it. But I think that people are so much stronger together. This is why I push this, because the trader wants to do everything on their own. And really what I'm trying to tell you guys is the more closely that you can work together, the better you're going to do. That doesn't mean that you want to create this huge community that's like millions of traders and then you're all trading some. No, that would be a bad idea. Okay. But getting a group of a dozen to 150 of you together to all work together in having better trading, 100%, you're going to do better. The more you can, the stronger the trading community you can build around it is. Because the people that we're trading against, they have a community. Okay. They have a community. When you're trading against Goldman Sachs, they have an army of 1,000 to 5,000 people behind them. So why shouldn't you guys be teaming up? Love to trade well. I'll thank you. I really wish I had better ideas about ways that we could improve the interactivity of the stream and stuff. I think we're doing better. I feel like this week was a little bit more of a discussion. I mean, part of that is because we're actually getting economic data and stuff to argue, argue. But it's fine as it is. But the thing that I want to do is I want to increase the community outside of the stream. Oh, I totally agree with you, Trading Bunny. My ideal, what I would think would be ideal for YouTube chat, Oh, it's so funny because when it started with Twitch, like behind Twitch was actually IRC. I wish that behind the YouTube chat was actually Discord. Like, I wish that I could integrate the Discord channel directly with YouTube, and like, you know, all of the features that are in Discord would be in YouTube chat and stuff. I am confused. I thought it would go up and do a slot. That's what I thought too, Golden Dragon. But I think that so I think there's two things. Number one is that there's Apple earnings and that's driving the markets up. And number two is that even though a higher than expected number is very bad for the market, last month's earnings or last month's job number was revised down a ton. And so I think that that maybe brought the market into thinking that it's okay and that we're in the like the golden, you know, just right area. Sorry, the Goldilocks zone. That's what I was looking for. But anyways, we don't have YouTube chat integrated with Discord, but we still have Discord, and we could make much better use of Discord. I'm thinking what I want to do on Discord is I want to make a new channel that would be called Guided Discussion. And in that channel, I would be allowed to create new threads and people would only be able to reply. I think that would be interesting. And then I could create topics and guide people towards talking about certain topics. I had that in the back of my head as well, and that makes sense for Apple for sure. Yeah, for sure. Now, with all that said, I think that the S&P 500 is probably still vulnerable. Like, one of the issues that we've been dealing with over in the S&P 500 is the intraday volatility and the 0-day to expiration options. And I'm sure that those guys are pushing it here. And at some point, they're going to take profits. So I think there's a very good chance that a large portion of this mean reverts. I think that it would be hard for them to get back, you know, end up negative on the day, but I bet you that they're going to give up a lot of these gains. And like, really, if you think about it, like if we ended the day at 41.35, that would be kind of like, okay. Now, if they keep going and they end up like above 41.50, because I think the thing that you're probably thinking and the thing that I'm definitely thinking right now is like, what are the chances that this turns into another one of those insane Bender trend up days like we had last week, you know, where they go up like 70 points in a day? Because it's kind of starting to look like that, isn't it? Friday rebalancing? I mean, it could be related to it being Friday as well. But I don't know, like the thing that I typically see on a Friday is like on a non-farms Friday is like they trade the non-farms Friday and then like volatility immediately dies down and like the rest of the day is a shit show if you're trying to scalp. And it definitely looks like that to me. Like the movement in the treasuries here is pretty lackluster now. Do you think the Fed is raising in June? We haven't covered that, but I would say right now, I think no. I think that they're really are gonna just hold rates all through the summer. So, and in other words, I am in the same camp as the Federal Reserve themselves, that May was probably the last increase that we have, and that they hold interest rates steady through the summer. But I do not agree with those in the markets that are pricing in a rate cut in July and August. Maybe September, but So what does that mean for markets? Well, so there's a couple of other things going on right now, including how they're handling the balance sheet and so on and so forth. I think that it will be a drag on the markets. I don't think that it has to mean like back to 3,600, but I think there's a really good chance that we get below 4,000 sometime in over the summer, let's say. So it'd probably be a slight drag on the S&P 500. With the RIT, and also though the thing that I'm really concerned about is that I think it increases all of the problems with regional banking. I think that regional banks are gonna have continued pressure, and that, you know, because once these interest rates start getting above 3.7, like, it's a real problem for them. That's what I'm worried about. Oh, is that you, Trading Bunny, trying to post the link in Discord? Yeah. It doesn't surprise me that Jeff Snyder was one of those people that immediately thinks that they'll start cutting rates immediately afterwards. Should we be, well, okay, so I don't know about the credit unions. I guess credit union, well, what I would be concerned about is like a bank's exposure to either treasuries in general or commercial real estate. Like, those are the things that's really killing them, right? A large bank, I guess. I mean, I don't want you to move. I want the small banks to stay. I want the regional banking system to get stronger, not weaker. I hate this, like, everybody moved to a big bank, but that kind of seems like where it's going. And which one of those you get into, I hate them all, you know. So is what it is. Oh, it's definitely a Friday, guys, because I've already got my mind on what am I gonna do this weekend. Yeah, there you go. So to the Jeff Snyder tweet, I think one of the problems that we're having here is that, you know, we thought that the SVB crisis was like a really huge deal, and a lot of people thought that that was going to be enough to reverse the Fed around. But what happened instead was they undid some of their quantitative tightening, and like already went too far to the point where like markets are like pushing up and so on and so forth. So I think that, yeah, probably results in recession at some point, but it just kind of like moved everything further back, right? Like every time we have a blow up that doesn't result in every time we have a blow up that doesn't result in like the end, like the real recession, it just kind of pushes the real recession a little bit further back. You know, so that's where I could see by September or October us being in a pretty tough situation. But I could also see that being pushed out even into next year again. Right? Which again, it's so because being in a recessionary environment during an election would be really, really bad for the Democrat Party. Be very, very bad for Democrat Party. I already think that this next election should be difficult for the Democrat Party. The electoral map moved in favor of Republicans a little bit, and the Democrat candidate is just not very good, right? The issue on the Republican side is their candidates aren't much better. And when I say much better, I mean within the context of like electoral popularity and stuff. Yeah, so maybe Chase. Yeah, I think that JP Morgan is so I think the big four are JP Morgan, Citi, Bank of America, and it would be the fourth one. I can't remember. Oh, is it Wells Fargo? I guess Wells Fargo was the fourth. I wouldn't go to Wells Fargo though. So yes, I guess it probably if I was to switch, I think I probably would go to JP Morgan Chase. You think Deutsche Bank is gonna go down? Could. I don't think it'll probably be a lot like the Credit Suisse situation though. There was for a long time there, like back in 2018, where everybody was convinced that Deutsche Bank was going to go under. So, the thing that concerns me is when I see a headline about a regional bank and the treasury market just goes wild, like we did yesterday, right? That's where I'm concerned. That's the sort of thing that could precipitate the recession. While I'm thinking about it, let's pull up the Fed Watch tool. See, now they're saying 91% that they leave the rate the same for June. But what about for July? And has it changed? Compare. It looks to me like the possibility of the cut, has increased. No. The possibility of a cut has decreased significantly. Yeah, there you go. Strangely enough, very, very few predicting a rate increase in July too, though. Does it get higher if I go further out? No, it does not. The further out you go, the more certain the market is that there will be rate decreases. So Here's another thing that maybe we need to consider with the S&P 500 here is that, you know, like we could be about to go into a recession. This could be a situation where like the market's recovering like before the recession even starts. So that's another thing we kind of have to keep in mind, is that even if our view on the economy is bad, the equity market could continue to do pretty okay. My nose itches like super crazy. Maybe they'll redefine what a recession is again. Yeah, I mean, I don't think that the whole thing is there's like that board that says what a recession is. I don't think that that period last year is going to be marked as a recession, right? So, but that's the thing, is when we actually do get a recession, like, is it going to be bad? How bad is it going to be? Oh man, I'm gonna pick my nose super hardcore because this itches so bad right now. Okay, I think I fixed it. I want to come in here and read a zero hedge story before we go. It's not all speculators, as real stress lingers in U.S. banks. Oh, this is a really important thing to point out. So the Goldman desk yesterday, in one of the notes that Zero Hedge is able to get their hands on, reported that when we were selling the other day, that they said that most of the selling was coming from long onlys, that the long only funds were seeing that as an opportunity to de-risk. Because a lot of people are saying, oh, it's just like short sellers trying to cause something to happen. That doesn't, I think that those short sellers are in there, but I don't think that that's what's creating all the volume. Okay. ADP jobs data are now much more accurate than non-farms payrolls. By Peter Cheer of Academy Securities, total jobs at 253K are good, but that number came with downward revisions of 149, which will keep the Fed at bay. It also makes me wonder why the market doesn't pay more attention to ADP. Last month, ADP was 142K versus an original print of 236K on non-farms payroll, which just got revised down to 165. 2 months ago, ADP was 261 while NFP was over 311. That got revised down to 248. With low non-farms payroll survey response rates and revised ADP methodology, maybe ADP day should be more important. I had not thought of it that way. I had kind of thought of it as ADP doesn't predict what the non-farms as actually looks like, but I didn't think of, well, ADP might be more accurate. Earnings could be problematic for the Fed. Last month's annual rate of 4.2% was a nudge up to 4.3%, but more importantly, this month showed a 0.5% increase, the largest monthly increase since 0.6 in March of 2022. There might be some devil in the detail issues with this number, but for anyone not looking at the nuances of the data, this will bring up concerns about inflation and the Fed. A report that overall will give inflation hawks at the Fed some pause and keeps us in the one and done-ish camp than the definite pause camp. Do stocks buybacks trump quantitative tightening? I do believe that quantitative tightening acts as a headwind to asset prices, but as we continue through earnings season, more and more companies are announcing their buyback plans. With their blackout periods over, they can initiate discretionary purchases. That is a positive for the market and should at the very least neutralize the impacts of quantitative tightening. Interesting. Where do bond losses come from? I'm not sure I have the cohesive theory or trade on the back of yesterday's bond loss piece, but something tells me it is worth a read as it will gel into a stronger view on tail risk markets are facing. Far more credit losses occur from forced selling than from the default. Oh, really? That's interesting. So they're saying that when you're a bond fund, that you having a bond and the buyer not, or the seller of the security not paying you, you're, you know, defaulting, is less of a big deal than it is like the value of the bond goes down and then you're forced to dump it instead of holding it to maturity. Interesting. All right, well, hasn't there been a divergence between the ADP? Well, yeah, like the whole thing is just like messed up, man. I don't trust the non-farm number at all. I'm not gonna say that it's like goal seeked or anything. Certainly that would be like a good reason to investigate, for people to investigate, right? But either way, I'm gonna go with the easier explanation, which is just there's problems with the survey that aren't intentional. How are things going, brah? No, we're doing good. We're doing really good. Hopefully I get my desk finished this weekend. Say hi. Dude, Asher is he's so autistic, man. He's like the most sweetest autistic child ever. Because autistic child usually doesn't like to be hugged or anything like that. He will just like randomly come over and like start smashing into you and wanting to hug you and stuff. But he seems pretty autistic to me. So it's kind of a sad thing. The thing that really gets me down these days is Ethan will communicate with me in ways that Asher never has. And it just makes me sad about all of the key benchmarks that Asher has missed. It really is. Oh man. It's kind of rough. I wouldn't say that it's like something like causing me like great distress or, you know, like a real problem with my mental health or anything like that, but it does make me feel down when it comes up. He will grow in his own way. I hope so. I was reading this thing yesterday. They used to say that if they get to 4 and they can't speak, then it's assumed that they just won't. But they did this survey of autistic, nonverbal autistic people, and they found that nonverbal autistic people will end up speaking at just about any age, all the way up into teenage years. Like that there's people that they didn't speak until they were teenagers, which is like crazy, right? Top 5 indicators. Cumulative delta, speculator sats synthetic dollar index, speculator sats spread indicator. What else do I use? Oh yeah, speculator sets multi ATR for your daily charts. And then R squared. Was that 4 or 5? That was 4. The inventory cost basis. Yeah, I think we could put inventory cost basis as a number 5. The inventory cost basis one is a wild indicator, man. Like it's too advanced. Like it's definitely doing something, but like so much more research needs to be done on how to use it, and like research that is beyond my expertise, you know. But the number of times that it will come down to that line and bounce off of that line, it's just, and I mean like perfect bounces off that line, or it's really something else. I can never predict when it's going to happen, but it happens a lot. That's actually not a bad idea for a video. I mean, I think that I really liked my last video, which was like why you suck at day trading, which was key components of a successful day trading strategy. That I really think provides a framework for retail traders about things to look at. That's a little bit more general. But, you know, having a video that's like top 5 indicators would also be one that I think people would click on and would be a really interesting video, especially people that like the channel would be like, Seth's talking about indicators? Okay. But then I'll just trash on indicators in the video. Do you have any statistics about Fridays being big runners? So I do actually. So, you know, I have that range histogram, and you can also use the range histogram and extend it into different indicators. Like for instance, I used the ADX as an indication of trend. And what I found was that Fridays in particular have a much wider range. So like, there are some days that are just like way more volatile than average days, and there's a bunch of days that are like way less volatile than average days. So it seems that like when you get something big going on Friday that it goes, but it doesn't look like that's today, man. S&P may continue rallying and that may end up being a big winner, but like the treasury market just looks dead to me. All right, well, I'm coming to my stop, so I'm going to stop the stream. I will catch you guys on Friday. Make sure to check out Discord. We'll keep the conversation going on in Discord. And yeah, so I'll see you guys on Monday. In the meantime, stay excellent, team.